Good afternoon, ladies and gentlemen. This is Robert Rayburn of Life Pro Asset Management. It is August 19th of 2022, and we got a lot to talk about this week. So this week in particular is the first week in a while where we've seen markets retrace some of the gains. That is natural. We came into this week short-term overbought as it comes in as we relate to a price perspective, whether we're looking at the NASDAQ or the S&P 500. Now, every once in a while, you're going to get markets that sort of race ahead of themselves a little bit and need to take a breather. I always compare this to a marathon runner, right? So as you're going down the trail of the marathon, you need to pace yourself. You need to, if you sprint the entire way, you're going to burn yourself out. And so really since June, markets have been kind of on this one-way path upward. And certainly they were deeply oversold. And that's natural, where you have a deeply oversold condition, markets violently bounce the other way. But then they need to take a breather. And that's generally what we've seen this week. We expect that to continue going into the Federal Reserve's Jackson Hole Symposium in mid next week. So likely see a few more days of weakness here. We are expecting it. Volatility is somewhat suppressed right now, so we naturally could see a rise in the VIX here over the next few days. But then I think the Federal Reserve is going to maintain its message. They are going to say, hey, we got our eyes set on inflation. Yes, we're not letting up on interest rate increases, but I actually think the market wants to hear that. The market wants to know that inflation is going to be a past story by the time we get into 2023. And that's really, at the end of the day, the whole point of this week's presentation, centered around, are we looking at price weakness, or is this really a recession? And are investors exposing themselves to a recession by being invested, or an inflation head fake? Right? Those are the two big things, recession or inflation head fake as it relates to the weakening CPI report from July. Is that just a one-off, or is it part of a broader trend? So the big things that we're going to focus on this week, the big three things: have the markets gotten ahead of themselves on inflation? The S&P 500 has now reached a 200-day moving average. Now what? Lastly, are investors getting too bullish, and does that portend more selling? Right? So has this rally been accompanied by this huge momentum in bullishness? So we'll go through all of that this week. So right now, we're right up against that 200-day moving average. So that's represented by this yellow line here. So the chart on the right is the S&P 500 from August 17th of 2021 all the way through to today. So a one-year chart, 52 weeks. And what we see here is we rallied strong out of that June bottom, retested a little bit in July, and then really kind of an upward shot since mid-July, and we've reached that 200-day moving average. From a technical perspective, just a great excuse for people to take some money off the table, especially with the Fed meeting next week. This is going to always represent some chop, and then at some point here, if our longer-term thesis is correct, we expect to break through that resistance. This week has been mostly programmed selling by computers, and we can see that here on this tick index. So this tick index looks at programmed selling across the NYSE, and we can see here on the New York the NYSE Open, huge volumes of just programmed selling. So not humans, not mutual funds, but mostly just quant funds that are taking money off the table, going back to this 200-day moving average ahead of next week's Federal Reserve meeting. So why do we not think this is a recession? Well, a few observations I would like to put up front for everyone. First, manufacturing is slowing, but it's still growing as per the ISM survey, right? Now, new orders are weak, and we want to see that. We want to see that inflation pressures are coming off a little bit. But part of the market weakness this week has actually been the fact that economic data remains strong, and that could mean more Fed rate hikes. And we see that 528,000 jobs created in the month of July. That's not a recession. Average hourly earnings are accelerating, part of the Fed concern, but again, not a recession. Upstream, downstream inflation, whether we're looking at CPI or PPI, again, slowing off a high boil, non-recessionary. And then, of course, strong retail spending. We saw that a few days ago. I think that was back on Tuesday or Wednesday. And again, that's not something you see ahead of or during a recession. Yet, we're mired in pessimism. So one of the questions we wanted to ask this week is, as markets rallied, are we seeing that pessimism translate into overt bullishness or optimism or runaway optimism that would give us pause and maybe start to raise cash? Again, we're just not seeing that in the surveys. So we can see here, global growth pessimism has eased from those all-time lows. But I mean, we're talking about a dead cat bounce here. We're like barely registering on the charts. And then when we look at the average cash levels across institutional investors, again, near all-time highs with the exception of July of 2000. So again, positioning remains bearish, sentiment remains bearish. So it's very hard for us to see how investors are too bullish at this standpoint, which I actually think is a bullish projection going forward. So when we look at the positioning breakdown, a few themes here. So this is a survey of overall institutional investor positioning. Cash remains king. Cash remains the number one overweight. Again, that to us is bullish, not bearish. Secondly, the demand for recession and inflation hedges remains relatively high. So we look at healthcare, REITs, utilities. Those are assets that tend to either do well during recessions or relatively well during recessions or during times of inflation. We see that with commodities as well. And then lastly, investors continue to flee those cyclical and secular growth areas of the market. So anything that's disruptive or economically sensitive, that continues to be relatively discarded. But as it relates to inflation, and this chart, by the way, is actually a day or two old. As of this morning, one-year inflation swaps continue to hit new lows. So, and that's something we want to see. And when we look at what are the number one concerns that investors have, guess what is number one? Inflation stays high. Well, guess what the swaps market is actually saying? That inflation has already peaked and that it's continuing to come down. But everyone remains positioned for inflation going upward, not downward. So that's important. And then what's the second big one? A global recession, right? Again, we walk through those numbers. The US is the engine of the global economy. There's no signs of a recession. So I don't necessarily see where that's showing up in the data right now. And then thirdly, a hawkish central bank. Part of the reason why you see some money coming off the table ahead of next week's central bank meeting. So our question again is this inflationary or deflationary? We looked at the inflation swaps market. That looks to us to be relatively deflationary or disinflationary. Gasoline prices. So gasoline prices broke under $4 last week and have continued to move lower, around $3.94 a gallon. Again, a lot of this, where we see this blue box here, that is August. In other words, we think that unless there's a dramatic shift upward between now and the end of the month, that should relatively be accretive to our disinflation story when that CPI report comes out in September, measuring August inflation. Prices up or down, right? So when we look at retail inventories, this is a chart of overall retail inventories. When inventories explode, what tends to happen? Sales, right? We saw that on the Walmart call and the Target call where executives were saying, listen, we got to get rid of this inventory. We even heard anecdotal stories about people returning stuff to Target or Walmart and the stores giving them the money back, but then saying, please keep the merchandise because we need to control our inventories. And then as it relates to job postings have actually started to come down, which should help ease some of those wage pressures here over the next few months. But we get it. Like, the world is a scary place. And, you know, what we showed here, the chart on the left, just shows a history over the last decade of all the different crises that we've had to navigate during what's been a 12-year bull market that ended this year, pretty much. And so we look at the EU sovereign debt funding, a China hard landing, geopolitical crisis, EU disintegration, US-China trade war, the presidential election from 2020, coronavirus, inflation, hawkish central banks, the war in Russia and the Ukraine. So again, the world is a scary place. Well, we believe that there will always be a crisis, right? That there's always going to be somewhere in the world that is a hotspot that gives us pause as it relates to putting money at risk. But all this really does is distract us from our long-term game plan. And it's the number one mistake that investors do make. Over the short term, it feels really great to get out of the market, especially when you're dealing with these scary headlines. But then 2 or 3 years later, you're going to look down and say, well, why am I underperforming? Why am I behind? And it's because of the short-term moves that you made, but you never really got back in at the right time. You got back in after prices already recovered. So we want to make sure that right now we're navigating this current time period with a long-term mindset. And we see with credit markets continue to improve. Now we have had a little bit of widening here the last couple of days. So this chart's a couple days old, but overall, unlike March where spreads were blowing out, we're actually seeing spreads come back in. So that's definitely something we want to see. So where do we fit in on that matrix? Again, we're still here on the right, moderating growth, moderating inflation, but not a recession. So that tells us value stocks shifting over to growth stocks. That's how we want to remain positioned. And again, short-term markets are overbought. We see it in every gauge. So that's natural coming off a bottom. So over the next week, we need to digest some of those gains, especially ahead of the Fed. And then we think the markets can resume some of that uptrend. The good news is institutional investors remain dramatically defensively positioned. And so whether you're looking at positioning data or sentiment data, everyone's negative despite the rally. And so that gives us optimism that the markets over the next few weeks can get back into that uptrend and continue to resume that recovery. And again, we just remain focused on those quality growth franchises. So thank you again to everyone. Have a great weekend. And if anyone has any questions, please reach out to your advisor or call us at 888-543-3776. Thank you again and have a great weekend.